So the plunge that we saw at the beginning of August, and by now we've spoken about it a few times, as I said, on my radio show. I've spoken about it with investors a number of times. And I guess we have to start by discussing why it happened. And I think it kind of breaks down, when we look back now into three reasons why it happened. Number one, and probably the most important reason, was the jobs data we received out of the US. We were expecting to see about 180,000 jobs created in the US, and the US only grew about 114,000 jobs for the month of July. We also heard from NVIDIA, a very important stock, which we're going to talk a bit about it later on this show. But we heard from NVIDIA, or at least we heard reports that perhaps the new chips from NVIDIA, the Blackwell chips, would be delayed until the new year. What effects would this have on a lot of big tech companies? Well, probably a pretty big effect. So if it is true and NVIDIA is delaying their chips to the new year, to the new chips, the new Blackwell chips, would this have a negative impact on tech stocks, on other chip makers, on some of the hyperscalers like Microsoft and Amazon and Google, etc.? So that was a bit of a fear that we heard at the same time as well. And lastly, there was talk, or there was some issues out of Japan. Japan had an interest rate increase recently, and that caused a bit of a panic. It's been a while since Japan raised interest rates, the carry trade, as we call it, basically taking Japanese dollars and investing in the US because US had a lot higher interest rates than Japan did. Japan's rates were always very low, next to nothing, whereas they could take their money and invest it overseas. Well, if Japan's raising rates and if the US is going to start cutting rates, that trade opportunity is getting less and less. And so that caused a bit of a panic because maybe perhaps some of the Japanese money that had been coming into the United States would start to pull out. So those three things really made us quite nervous. But looking back, I said to investors at that time, I did not believe that the pullback was justified. 115,000 jobs created for the month of July, I thought was good enough. Yes, we saw a new number given to us for the month of June. So the month of June was redone, or I guess recalculated, and it came in below 200,000 jobs created. It was over 200,000 jobs. I believe it came in at around 179,000 jobs created. So a new number, but at the same time, it's still a good number. And this talk about, well, we have to fight inflation quickly became to talk about, is the United States actually headed for a mild recession? Has the Fed not moved quick enough in cutting interest rates? And to me, this fear was one that was created by investors themselves. I think it was created by investors. It was created by the programs, the computer programs that were trading on that day. And if you recall, it was the Monday of our long weekend here in Ontario, civic holiday. It was the Monday of the long weekend where the US markets, Dow Jones dropped to over 1,000 points. So I believe the fear was overdone. And I guess my main message to all of you watching today, understand and remember this time, because there's going to come another point in time when the markets pull back and investors are going to be fearful once again. And I'm hopeful that a lot of you investors will remember these past experiences and take something from them for the future. Don't panic. Don't call your advisor, wanting to know whether you should be selling everything and moving to cash. That is not what we do, not what we want to do, especially if you're a long-term investor. We want to take advantage of these pullbacks that aren't for fundamental reasons, and I don't believe they were for fundamental reasons. The fundamentals in the United States are very strong. Fundamentals in North America are strong. Around the world are strong. So to fear a very large pullback, one of 10, 20%, at this time, I thought was silly. And so those that took that approach and used this as a buying opportunity, bought on the dips, they made quite a bit of money over the past few weeks. So let's look at a few charts to illustrate what I am talking about. First chart we have is US job creation. And as you can see here, 114,000 jobs for the month of July. We can see that as I said, the prior month, June, was revised down below 200,000, 179,000 jobs. And you can see the last 3 months, a nice steady decline, again, causing fear in the markets. But we know that, I guess, a few weeks before, maybe I think it was maybe 10 days before, we actually received or saw a GDP number out of the US, so a growth number out of the US, which showed nice growth. And we have a chart on that. Gross domestic product in the United States, there it is, 2.8%, well above what it was in the quarter before. And so, yes, maybe not as much as the fourth quarter, but still, when you come in at almost 3% growth in the United States, that's a pretty good number. So, yes, we saw some weaker jobs numbers, but we saw some really good growth, GDP growth out of the United States. And shortly after we saw the jobs data, retail sales came out just recently in the last few days. And let's show a chart on that. We actually saw a full 1 percentage point increase in retail sales, well above what they were expecting. I think they were only expecting something like, well, less than half a percentage point. And now retail sales, 1 full percentage point month over month. So what does that mean? Well, that means individuals are spending money. The consumer continues to consume, spend money. Yes, they may be consuming on their credit cards. They may be borrowing money, but they are still continuing to spend money. So I think, in my opinion, this economy is far from a recession. United States economy, that is far from a recession. But let's take a look at what happened at the beginning of August. Let's take a look at a chart of the S&P 500. Chart of S&P 500, there you have it, beginning of August. What a major downturn. And this is what caused the fear for investors. Is this something, the start of something bigger? Or is this going to be an opportunity? And as you can see, it clearly was an opportunity, a short-term opportunity. Let's look at our next chart, which is a chart of the VIX. Now remember, this is a volatility index. This measures volatility, fear out there in the marketplace. And look at that spike. Wow, up over 65. We haven't seen a spike above 60, in around 65 since COVID times, since the recession, the financial crisis. So was this a time that would equal out the same time we had during the pandemic or the financial crisis? Absolutely not. Well overblown. And I can tell you now, the VIX index or the volatility index is below 15. So it spiked up to 65 and has come down to below 15. So was it overdone? Absolutely. Was it an opportunity, especially for buyers or investors that had some cash on the sidelines? Absolutely. So keep in mind, when these things happen in the future, you want to look at what you can do to take advantage of this time, especially if fundamentally the market is doing well, if fundamentally the economy is doing well, as we saw in the United States, 2.8% growth. So instead of being nervous, being fearful, try and take advantage of the opportunity. And that's the best advice I could give to all of you going forward. But keep in mind, every time these things happen, you want to assess why they're happening, which is very important. And then you want to act appropriately based on your assessment, on your research. And in many instances, you will find that the right thing to do is not sell, but in fact, be a buyer of this market.